And on today's show, how to frame the game of paying the least amount in taxes. Part one of this week's series on end-of-the-year income tax planning for 2014 with top producers Mike Kilbourn, CLU, ChFC, and Ron O'Dell, CFP. Hi everyone, I'm Steve Savant, Syndicated financial columnist and contributing author to Innsmark, Life Specs, and Backroom Technician. Let's get down to business. Well, welcome to the show, Rob, Mike. End of the year, everybody is hunting to pay the least amount in taxes, and a lot of our advisors are using this as a tactical way to get in front of their clients, which I think is a great idea. You have both been huge in this arena of tax planning. I want to kind of go to this map that you've actually created, Mike. It's quite outstanding. And I want you to kind of walk us through the mechanics of the basics. Now, I've heard when we're talking about 1040, exemptions, credits, deductions. Are there ones that are more powerful than the other? Are there ones we should be looking at to put in front of our clients?
Absolutely. Yep.
So tell me about this.
Well, year-end tax planning is huge because it's immediate gratification. Clients can save money now and attribute it to us, the advisors, who are telling them what to do. But there are certain definitions you want to look at when you're doing your income tax planning. The first biggest one is called the line. Above the line, below the line. And why is that important? Because it determines AGI. Deductions that happen above the line are not factored into your AGI. The deductions after, such as itemized deductions below the line, are factored into AGI.
So in your view, that's more important?
Above the line is more important.
It's
a more valuable deduction there.
AGI is adjusted gross income.
We've heard the differences when people are looking at different areas of deductions, exemptions. Certain exemptions phase out because of income.
Right.
Yes.
Certain deductions are worth more than others. And then tax credits, you can only really use them, though, if you have taxes due.
But tax credits are the best of the group, so they come right off the tax itself, and that's the beauty of a tax credit.
Now, if I use a tax credit, do you think, is that coming off the AGI line, or is that coming off this new thing that everybody keeps talking about called MAGI, modified adjusted gross income?
Neither. It's coming off the tax liability that you owe. So if you owe $10,000 of taxes and you get a $1,000 credit, you pay $9,000 in taxes for that year.
Do you think that from a strictly advisor point of view, is this a really hard area to conquer, these basic concepts of a 1040?
Well, after the 2012 American Taxpayer Relief Act, absolutely are. There's more moving parts in the tax code than ever before because you need to look at adjusted gross income, taxable income. MAGI is just mentioned, modified adjustable gross income.
Well, when we were driving here today, I made some notes, and the tax rates, I thought to myself, are exposed to numerous factors, and here's just a handful. See, certainly the tax brackets, but then there's the phase-out of exemptions and deductions. We'll talk about those definitions. The long-term care, capital gains, qualified dividends, alternative minimum tax rates, alternative minimum tax exemption, phase-out, the 3.8% Medicare tax that we'll cover in a future show, income tax-related Medicare adjustments to Part B and Part D for those people that are on Medicare, and then the taxability of Social Security benefits. I mean, all of those things add up to, well, I can't figure out my bracket anymore because I've got to know where I am on all of these different issues.
Well, and later on in the week, we're going to talk about your idea called tax bracketology. I think you call it bracketology.
Exactly.
Wow. I mean, we're really managing issues now, and I've seen a lot of tactical issues learning how to figure out what your bracket is. If I take, and I'm quite curious now, if I take my exemptions, my deductions, and credits, I've taken it all out, but I still have whatever I paid for the year. Is that my effective tax bracket?
That's your average tax rate,
That's my
if you will.
average tax rate. We're in a marginal tax bracket.
Correct.
So all these things matter. I noticed that you said, though, Michael, you said AMT. Now, we finally caught up the inflation. We kind of caught up sort of, right? How is AMT? Are you seeing clients still paying AMT?
Alternative minimum tax, and while the exemption's been raised, it affects so many more Americans. People have no idea, and suddenly their accountant says, well, you're going to owe more than what you think because of the alternative minimum tax.
Are there any proactive issues that we can do up front, while we still have about 3 weeks to go in the year? What can we do to try to mitigate this, even if it's AMT or we're looking at ordinary income tax or even our capital gain issues?
Well, right now, we're engineering our clients' tax returns. So I'm sitting with all my clients going through looking at their tax return for 2014, so there are absolutely no surprises come April next year when they file their 1040.
Well, I've noticed, though, Michael, is a lot of people go to their CPA after the fact. The CPA community is not really proactive in planning for tax. They do the taxes on the basis of the shoebox that they're handed.
Right.
But really, in fact, I don't really see much proactive
Well,
to
that's
planning.
why the advisor can step in and help work with the CPA and the client and figure out how to focus them on these important issues to, for example, defer income to another year or increase deductions for this year. I mean, if you were to pay taxes on your home, maybe you can push it off to January if you need to, or you pay it this year.
In fact, in financial planning, the biggest disconnect or inefficiency in financial planning is the lack of communication between the financial advisor and the tax professional, CPA, accountant. If you can get those two talking on behalf of a client, great things can happen for the client's tax return.
Now, do you team up? Both of you team up with CPAs to do exactly what you're talking about?
Absolutely.
And they embrace you.
Well, we firmly believe in the team approach. In fact, we have something called the Wealth Protection Network that we created over the years, and we drag in professionals that are top of their game, and those professionals include CPAs, financial planners, money managers, insurance professionals, development directors, trust officers, all who specialize in family wealth transition planning.
We come back from the break. I want to talk about this American Taxpayer Relief Act and the impact it has today. Right after the break, we'll get into it, and I want to know how Rob and Mike think about this, because I think this has major implications. We'll be right back. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance, designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the practice enhancement company. Welcome back to our second segment. Of course, we're with Mike Kilbourn and Rob O'Dell. Rob, kind of introduce us into this whole thing of the Relief Act, the so-called Tax Relief Act of 2012.
Tax Relief Act.
There's not really a relief, but whatever.
Well, this is the last big bill that was signed on December 32nd, 2012, also known as January 1st, 2013. It was argued then, I think it was signed actually on January 2nd. It created a number of items that we as advisors need to know about when we talk and advise our clients. Several things it did. The very first thing, it ended the Bush tax cuts that were put in place in 2001 and 2003. If you remember, they only extended 10 years because they did not have a supermajority in Congress to make them permanent during the Bush administration. So that they came to a sunset. The second thing that it did, it created a new 7-bracket system. And the 7 brackets we will unpack when we get into tax bracketology in a later show this week. But it made the rates much more progressive, and also it ended the marriage penalty, or created the marriage penalty for those in higher income brackets. The third thing that's very significant, and we're really going to unpack this one in future shows, is the charitable IRA rollover, which benefits the lower income taxes as well as those who pay high amount of income taxes. And we'll go through that. I'll give examples.
Well, I think that's really remarkable, because generally when we're playing in the tax planning end of the year kind of scenarios, it's usually upper middle class and higher. But you have a lot of tactics and techniques that have to do with regular middle class people, and it really can impact their tax bracket.
People in the 15% bracket can benefit probably the greatest by the charitable IRA rollover. I was working with a client just this past last week, did an income tax projection. Their tax was literally halved by taking advantage of that one little provision. We'll talk about it.
Now, Mike, when we're talking about stealth taxes, I don't like the taxes I see. Now you're telling me there's taxes under the radar.
Oh my God! In fact, there was a congressman named Pease who's dead now, but he came up with a tax. It wasn't really a tax. It was going to take away some of your deductions, which is in effect a tax. In fact, if you're in the 33% bracket or higher, it represents about 1% additional tax on your income. And so there's a P's, and then there's the phase out of your personal exemptions. It's the PEP, personal exemption phase out. And so those two affect your tax. In fact, that for every one exemption you have that you lose, it is like another % tax on top of that.
Now how do those stealth taxes then, how does that actually integrate or correlate with Medicare?
Well, then Medicare, you have a 0.9% additional Medicare tax on income above a certain level, and that one is really creeps up, particularly people that work for themselves and high earners get stuck with that extra tax.
So when we're looking at some of these tactical issues that really we're trying to somehow, some way work with this new act that was imposed on us January of 2013. When I'm looking at some of these, I'm looking at like qualified dividends. When you're looking at capital gain, everybody's trying to do the harvesting at the end of the year. They're losers and winners. Walk us through that, because I think that's kind of, everybody's a lost art.
It is, and especially now after this act, there's so many moving parts and so many different things we need to look at, thresholds we need to look at, whether it's adjusted gross income for $250,000 with the new surtax coming into play, as well as for those who are in the 15% bracket, if they realize a long-term capital gain on stock sale or mutual fund sale, they'll pay zero taxes if they're in that bracket. And there's effectively 4 different tax rates that you're paying on capital gains and qualified dividends.
No, see, I thought there was only 2.
Yeah, there's
15,
you actually.
20?
Well, you thought there were 3. There was 0, and then there's 15 and 20, but there's actually 18.8 because when you get to a certain level, which happens to be for married filing jointly $250,000, and you go above up to another level, it's actually 18.8 because you get your 15% bracket, and then you get that god awful 3.8% additional net investment income tax.
I don't know how, I'm so glad you brought that up, Mike. I really don't know if our advisors know that, because now I have a 4th bracket, as you just said, that's in there because of that one singular issue alone.
Right. In between $250,000 for a married couple up to the 39% bracket is that 18.8% bracket
so
we're at.
capital gains is not quarantined away from this issue.
Not at all.
So it actually, this is actually the way you said it, that's a revelation to me.
Well, dividends got thrown into the formula too, so we have dividends and capital gains. So dividends are also taxed at a certain level at 20%.
Now, we mentioned this on the first segment. We talked about the AMT. We finally got it somewhat indexed, but I'm surprised at how many middle-class people are still paying the alternative minimum tax.
Well, all they did was index it. So they didn't change it, they didn't revamp it, they just gave a little bit of index, which they should have done back in 1969, but it was never indexed back then. So that people are paying it. Middle class people do pay AMT, and it's very difficult to plan around alternative minimum tax, also known as alternative maximum tax.
And when it came into play years and years ago, it was intended only to affect a few families, and what happened is it just never went away and it got stuck, and now it's affecting millions of taxpayers.
Well, if I've looked at what I'm allowed to take on a deduction, my exemptions, whatever tax credits, and I still have a bill that I'm not happy with, are there other tax advantage or tax favored things that I can do today to make some kind of impact for my taxes this year?
Well, you need to, before 12/31, you need to be doing planning right now. So charitable deductions, charitable giving is a very big one you can be doing. You can be selling tax losses, whether it's real property or ordinary losses. If you have an annuity contract at a loss, you can take losses there. So there's many different things you can be doing now, but now's the time to be doing this with your clients before you get to the end of the year. Once you go January 1st, it's water under the bridge.
So advisors need to get hold of their clients and say, let's have a discussion about your taxes, and maybe I'll work with your accountant to try and come up with some ideas for you before you're in.
Well, that's all the time we have for today's show. Remember, before moving forward with any of the ideas you hear on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just go out to our video archives. And remember, you could be wiser as an educated advisor. I'm Steve Savant. We'll see you tomorrow.